After a challenging 2022, the first half of the year has brought mostly good news for investors. Economic data has been better than expected. The long-awaited trend of disinflation is alive and kicking, and an artificial intelligence frenzy put US stocks back in the driver's seat. The result? The S&P 500 now sits up 20% from October lows, with volatility at its lowest level since before the pandemic. As we look ahead to the second half, the probability of a deep recession for the US economy has certainly receded. But we are not out of the woods just yet. A successful soft landing depends on two competing outcomes: growth that's not slow enough to raise recession concerns, yet not hot enough to reignite inflation, and a hawkish Fed. All of this suggests that while there is a path higher for stocks, it's likely a narrow one, with US equities already priced for a very optimistic macro environment. So instead of chasing the market, we believe investors should take other actions. First, look for laggards. So far this year, 80% of S&P 500 gains stem from the performance of just 7 mega-cap stocks linked to the boom in artificial intelligence. While we do believe AI is a transformative technology, valuations for many tech companies likely already reflect the near-term upside. So within the US, we expect the gap between the leaders and the underperformers to close, and recommend rotating into areas like energy, industrials, and consumer staples. It also makes sense to seek opportunities outside the US in areas like emerging markets. That being said, more broadly, we still recommend buying high-quality bonds over equities. In recent months, yields have risen to attractive levels as the higher-for-longer sentiment returned. Now, it makes sense to lock in those yields before the attention pivots back to rate cuts in 2024. As growth slows, we continue to prefer agency mortgage-backed securities and investment-grade corporates. And we also like preferred securities, which feature attractive yields of around 7% and the potential for price appreciation. Finally, investors should diversify with alternatives. In periods of economic uncertainty, certain hedge fund strategies, such as discretionary macro, can take advantage of dislocations in the market. Meanwhile, private markets can help boost income and growth over time. We see opportunities in secondaries, private credit as regional bank lending to middle market companies shrinks, and private real estate, especially in areas like data centers, warehouses, and logistics. We encourage you to reach out to your UBS financial advisor to discuss how these recommendations relate to you.